Hey traders, and welcome back to another episode of Trade Like Assad. Are you constantly getting stopped out of your trades? If your answer is yes, you're definitely not the only one. But don't worry, in this video, we're breaking down the top entry confirmation tools and strategies that can lead you toward becoming a consistently profitable trader. You'll learn how to apply these techniques to your trading, gain clarity on how professionals confirm their entries, and significantly improve your success rate in the market. We'll walk through the core and essential types of entry confirmations, from simple setups to more advanced methods, all designed to raise your win rate and give you greater confidence when placing trades. So traders, if that sounds like something you'd benefit from, make sure to hit the like button to support the video, and don't forget to subscribe to our channel if you're new here. See you right after the intro and disclaimer. Welcome back, traders. Let's dive right into executing successful trades. Confirmation signals are key. We consistently seek additional trade confirmations to improve setup quality, as they help us eliminate uncertain entries by layering more validation into our trading approach. In this session, we'll unpack the tools and patterns that act as extra confirmations to reach better trade setups. These add precision and purpose to our strategies, helping screen out weak entries. Now let's explore the primary types of confirmation techniques that can elevate your trade quality and spotlight high probability points of interest. First, we have the VSR method. Second, we look at using volume indicators on order blocks. Third, we apply the discount and premium zones more strategically to avoid risky trades. Fourth, we utilize the fixed range volume indicator to highlight zones of supply and demand. Fifth, we tap into second mitigation zones that follow a market structure shift or change of character. Now, let's go deeper into each of these confirmations and learn how they integrate with smart money concepts for stronger trade validation. Starting with the VSR, or V-shaped recovery, this pattern reflects sharp price movements. When price hits a demand zone, it may drop rapidly and bounce back just as quickly, forming a V shape. Conversely, in a supply zone, price might spike up and fall back, creating an inverted V. This pattern signals heavy institutional activity, suggesting large-scale buying or selling within supply and demand zones. The reason this matters is because institutional money drives strong momentum, and aligning with that flow on a retest of those zones can increase your trade's potential. However, not every sharp price swing should be mistaken for a valid V-shaped pattern. Only those that occur within or close to supply and demand areas, and show clear structure, should be taken seriously as signs of institutional presence. Let's go through a few examples. On the screen, we're looking at the euro-dollar pair on the 15-minute time frame. You'll notice that price made a sharp drop, forming a swing low, right after interacting with a higher time frame demand zone. It then rapidly climbed back to its prior level, forming a clear V-shaped pattern. This price action established a new demand zone and revealed a fair value gap, both offering strong setups to consider going long, either from the demand area or the fair value gap. The V-shaped move suggests that buyers stepped in aggressively at the bottom, showing strong buy-side momentum, likely from institutional players. When you identify a V-shaped reversal in combination with a market structure signal, such as a change of character, your confidence in the trade increases significantly. In this case, spotting that V-shaped formation can be viewed as a bullish confirmation, hinting at institutional entry. As a result, it might be a valid idea to enter a long position, aiming to capture the potential continuation of the upward movement. Now, let's shift our focus to the second confirmation method, which involves using volume indicators in key supply and demand zones. Volume is generally displayed using vertical red and green bars along the x-axis, reflecting the number of executed orders during specific time frames. This tool measures trading activity, not momentum. Each individual bar represents the total number of buy and sell orders completed during the candle's timespan. A green bar typically indicates positive volume, suggesting bullish behavior, while a red bar reflects negative volume, indicating bearish movement. The color is based on whether the candle closed above or below its opening price. When volume rises during an uptrend, it signals trend strength and heightened buyer interest. On the other hand, falling volume during an uptrend might mean buyers are losing momentum, potentially leading to a pullback, pause, or change in market structure. Likewise, rising volume in a downtrend shows continued bearish force, while decreasing volume in a downtrend hints that sellers may be losing control, often pointing to a potential reversal or correction. Now that we've gone over the core concept of volume indicators, let's combine this with order blocks for a stronger entry signal. As you're aware, order blocks are decision-making zones where institutions typically place major trades, and price is likely to respond when revisiting these zones. Spotting a sharp rise in volume when price approaches or forms around a supply or demand area supports the presence of institutional activity and strengthens the validity of the order block theory. This gives us another confluence point before making a trade decision. A sudden spike in volume within these areas suggests that they are significant, and if price revisits them, there's a strong chance those zones will hold. While this isn't a confirmation you'll always see, and it's not absolutely required, it can still serve as a powerful signal for identifying high-probability supply and demand zones. Now, let's get into the next confirmation technique, identifying premium and discount zones. If your goal is to place trades with the highest chance of success, incorporating premium and discount areas into your trade filtering process can greatly boost your win ratio. As a general rule, for a high probability setup, it's more favorable to buy in discount zones and sell in premium zones. These areas also serve to refine the selection of higher quality supply and demand levels where entries can be more precise. For instance, in a bullish trend, focusing on demand zones that are located within the discount region can sharpen your trading edge and reduce potential losses. Typically, to identify these premium and discount areas, we use the Fibonacci retracement tool. Now let's go through the steps of how to plot these zones accurately on the price chart. To use the Fibonacci retracement tool in a downtrend, start by selecting the tool and dragging it from the most recent swing high to the most recent swing low. This action will plot the Fibonacci levels directly onto your chart. The zone below the 0.5 level is known as the discount area, while the range above the equilibrium line is considered the premium area. Keep in mind that these zones are only dependable when price makes a strong impulsive move that breaks a recent structure. To make our interpretation of premium and discount regions even more effective, we can break these areas into 3 equal segments and assign them different colors. This visual division increases clarity and helps identify high-probability trade setups. The goal is to enter buy trades in the discount area and execute sell trades in the premium area. On the chart, the red zone indicates a deep premium area, which may provide a solid opportunity for selling. On the other hand, the blue zone reflects a deep discount area, often ideal for buying. Avoid placing buy orders in the red zone or sell orders in the blue zone, as these moves go against the natural flow and may result in stop-outs due to low liquidity during volatile swings. Trading within the gray middle section is moderately safer, but the further price moves toward either the premium or discount extremes, the risk of reversals increases if you trade against those zone colors. For instance, in a bullish market setup, the price forms a bullish break of structure by moving above and closing beyond the previous swing high. By applying the Fibonacci retracement tool from the most recent swing low to the most recent swing high, we can clearly outline the deep discount, premium, and neutral gray zones on the chart. Since the objective in this case is to initiate long positions, we can refine our setup by disregarding any demand zones or fair value gaps that appear within the deep premium or gray regions. For stronger trade confirmation, we should concentrate solely on demand zones or FVGs located inside the deep discount zone. Next, we introduce the fixed range volume indicator, also called the fixed range volume profile. This is a technical tool used to visualize how much trading volume has occurred at various price levels over a specific time frame. It displays a vertical histogram that represents the volume traded at each level within the selected range, helping traders detect key supply and demand zones. The tool calculates the total volume transacted at every price level, combining both buy and sell activity. Now, let's explore how we can utilize the fixed range volume indicator as another layer of confirmation for better trade execution. To apply this indicator to your chart, go to the Indicator tab, type Fixed Range Volume Profile in the search bar, and click to add it. Once it's added, you need to define the range for your analysis. You can do this by selecting the starting and ending points on your chart, based on the section of price you want to evaluate. In this example, I'll choose the highest and lowest points of the bearish impulse that led to a bearish change of character, where price broke and closed beneath the latest swing low, as our volume range. As you can see, the volume histogram now appears within the selected price range. So, how can we use this to our advantage? In this case, price has shown a change of character, signaling a potential market shift from bullish to bearish. Using concepts from smart money theory or ICT, inner circle trader, methodology, we look for an opportunity to sell from the supply zone created by this bearish shift. Since the fixed range volume indicator highlights where the most trading activity happened in the selected range, we can pinpoint price levels with high volume concentration, often indicating key supply or demand zones where price is likely to react. Here, most of the volume appears within the upper range, marking a supply area. This area aligns with the order block that formed due to the bearish change of character. Therefore, with the help of this tool, a short entry could have been made from the extreme end of the order block, backed by the volume confirmation. This indicator reveals volume-heavy levels and helps identify order blocks, making it highly valuable. However, it's important to remember that it's not infallible, and entries should not be based on this tool alone. That said, among all the volume-based tools available, this one remains the most effective and accurate. It works best when used as an additional confluence to increase your trade's probability of success. Now let's shift to the fifth confirmation method, the second mitigation zone that appears after a market structure shift or a change of character pattern. To make this easier to grasp, let's walk through a practical example. In this scenario, the market is clearly in a downtrend, with supply zones maintaining control. After a brief consolidation, price shifts upward, creates a pullback, and eventually taps into a higher time frame supply zone. The market reacts to this zone, reverses direction, and forms a change of character on the current time frame. Now, let's assume we didn't take an entry during that initial move and are currently watching for a short opportunity. To proceed, we wait for price to break and close below a key structure on a lower time frame. As soon as this change of character occurs, we anticipate a retracement where price returns to mitigate the order block formed inside the higher time frame supply zone. This would mark the second mitigation of the higher time frame supply area, since the order block from the change of character wave lies within that same supply zone. Therefore, in this method, the idea is to wait for the first mitigation and reaction, then seek to enter on the second mitigation, offering greater confirmation that the zone will hold. This strategy helps validate that the supply or demand zone is respected, increasing the odds of a profitable trade. Generally speaking, second mitigation order blocks serve as high probability entry zones, as they often remain intact and are less prone to failure. However, one critical condition must be met for this method to be valid. Price must form a lower time frame order block that is in alignment with the higher time frame bias and is located within a key higher time frame order block or point of interest. If this condition isn't satisfied, then relying on a second mitigation entry isn't advisable. That wraps it up, traders. Thank you for tuning into this video. I hope you found this video insightful and helpful. If you did, make sure to give it a thumbs up, subscribe to the channel, and enable notifications so you don't miss any of our upcoming content. We truly value your thoughts and suggestions, so feel free to drop a comment below and let us know what topics you'd like us to dive into in our future videos. Thanks again for your continued support. We'll see you in the next episode.